Hi guys, in this video, let's talk about financial liabilities. So what is a financial liability? A financial liability is a contractual obligation to deliver cash. For example, you have payables, right? Again, you have issued loan notes, issued debentures. So those are financial liabilities, right? When it comes to financial liabilities, guys, initial measurement is always at fair value. That is the cash proceeds you receive. Okay. For example, you issue a loan note for 100,000 and you get $100,000 of cash from outsiders. So that $100,000 is your initial measurement, right? So that is what is called the fair value, guys, the cash proceeds you receive. Okay. The point is what to do with the transaction cost, right? So that will depend on your subsequent measurement. If you choose FVTPL, fair value to profit or loss, as your subsequent measurement, the transaction cost initially you have to expense to statement of profit or loss. Okay. If you choose amortized cost model as your subsequent measurement, right? So at initial stage, what you need to do with transaction cost is you have to remove the transaction cost from the carrying value of the financial liability, right? Remove in the sense you have to deduct the transaction cost from the carrying value of the financial liability, right? That means, guys, you have to debit the financial liability from the amount of the transaction cost. Okay. Then subsequent measurement, we have two options, guys, FVTPL and amortized cost. If you are using FVTPL as your subsequent measurement, initially you have to expense the transaction cost to statement of profit or loss. Okay. If you are using amortized cost model as your subsequent measurement, okay, you have to deduct the transaction cost from the carrying value of the liability at the initial stage. Okay. Then, guys, if you are using amortized cost model, you have to obviously use the amortized cost table. Right. Now let's look at the format of the amortized cost table. So, guys, this is the format of the amortized cost table. You have year, balance brought forward, interest expense, how to get the interest expense, balance brought forward into effective rate of interest. Minus, you have the interest paid, that is nominal value into coupon rate. Then you have the carried forward. So this column, guys, this column interest expense goes to statement of profit or loss as an expense. This interest paid column goes to statement of financial position. Sorry, this goes to statement of cash flows, right? And guys, this carried forward goes to statement of financial position as your non-current liability. Okay. Now let's look at example, guys. Example. Read along with me. Harry's company Watermelon Sugar Co. issues a $100,000 loan note at par. He incurred a transaction cost of $5,000. Coupon rate is 10% and the effective rate is 20%. This is a 3-year loan note. What is the balance of the financial liability at the end of year 1? They are telling the company uses amortized cost model as subsequent measurement. Okay. Let's look at the initial value or initial measurement. So guys, since amortized cost model is chosen as subsequent measurement, initially you have to deduct the transaction cost from the carrying value of the financial liability. So from $100,000, right, you deduct the transaction cost or debit the transaction cost, 5,000, then you get the initial value as 95,000. Okay. So that initial value, you put it inside the amortized cost table here, right? So then interest expense, that is balance brought forward into effective rate. So 95,000 into 20%, right? That will give you 19,000, right? Minus interest paid, that is nominal value into coupon rate. Nominal value is $100,000. That is into coupon rate is 10%, guys. That will give you 10,000. Then you will get the carried forward answer, right? Then you will get the carried forward answer. So this is what you need to remember, guys, basically with regards to financial liability. Okay. So guys, let's meet in a new video. I'll be talking about factoring. I'll be talking about convertible loan notes and more financial instruments in future videos, guys. So thank you for watching. Have a good day.